Welcome to the recording of the Retirement Café virtual event, which we held over Zoom at the video conferencing software on the 3rd of April 2020. We got together with a number of podcast audience and clients of NFP Wealth Management, and we welcomed Abraham Okusanya from the Timelineapp, who sponsor the Retirement Café podcast. Abraham gave us some powerful visualizations of historical market events and historical events to put this stock market in context. He showed us why the bear markets are a feature, not a bug of investing. Now, please note, this is not individual advice. If you need that, then you need to go seek a regulated financial advisor who will give you specific advice to your circumstances. But hopefully you'll find this information useful. Please leave a comment below if you'd like to know anything else. Brilliant. There's Richard. Hi, good morning. Fantastic. Here we all are. Here we are. There's Peter Crane has joined us as well. Jane Finity, you've joined. Great. Hi, Jane. Nice to see you joining the Retirement Cafe. Okay, so we've got quite a lot of guests on this morning, so you're all very welcome again. I've got some special guests that I'll introduce as well. Okay. So yes, if we could try and mute yourselves, everybody, and then if you then want to have a chat or comment or contribute to this morning's conversation, you're very welcome to. But just unmute yourself and then you can talk, and it just prevents any background noise or feedback that we get, because the way Zoom works, as soon as it hears someone talking, it flips them over to that person, of course, which causes if we get children in the background or that just causes a bit of an issue. So we're just coming up to a few minutes past 11, so we'll crack on. I noticed that we've got within the group this morning, we've got lots of clients and lots of guests, which is great. I don't know everybody, but I see that Parissa's joined. Parissa Jones. Haven't got your video on, Parissa, so maybe you've got the.
Which is probably a good thing because I've got a bit of a messy house at the moment.
No problem. Parissa, your audio is not brilliant anyway, but are you?
On my desktop, but I can always try and reconnect from my mobile.
Yeah, when we spoke yesterday, your mobile was very good. Yeah, so we'll just mute you for a second again, and then we'll come back to you. Parissa is. I've got feedback again. Can you please all mute yourselves? If you or Ryan, if you could try and control the mutes, that'd be brilliant. So Parissa is joined us from Leicester Aldridge, so we've got another solicitor on the call. So if anyone's got any legal questions they want to ask since our last meeting last week, Parissa is the person to chat to, which is great. But we also have a very special guest, a friend of mine and the sponsor of the Retirement Cafe podcast and the Retirement Cafe events, Abraham Okusanya. They're joining us from probably from home, I think, Abraham. I'll let you unmute yourself.
We're all at home, unless you're breaking the law.
So Abraham is he's the founder of the Timelineapp, which is a piece of software that kind of analyzes data and stock market data going back, probably hundreds of years. But I know the data that we look at is going back to kind of 1926. And many of clients of mine will have seen me use Abraham's software often in meetings, etc. So welcome, Abraham.
Hi, Justin. Thanks for having me. It's a pleasure.
Now, I know that you did a presentation to financial advisors earlier on in the week, which I found absolutely fascinating. And I asked you to join this morning to share some of the slides that you talked to the financial advisors about why this time in stock market declines, it's not different.
Indeed. So, I mean, whatever happens from here, it's all your fault. You decided to unleash me on these lovely people. I don't generally get the opportunity to speak to real people. I tend to talk to financial advisors. So whatever happens, it's his fault.
Absolutely. And of course, Abraham is not a financial advisor, so you can't sue him. So I'm the one responsible for the financial advice. And by today, and of course today, I'm not giving anyone financial advice because always that's very, very personal to your own circumstances. But what we are going to talk about is what's going on with stock market investments, where we are, why Abraham and I don't think this is unusual or different this time. And we're going to try and put a bit of context around that so that you get an idea of where we think we're at. These aren't forecasts. You know me, I don't do forecasts. I haven't got a clue what's going to happen next week, and I didn't see this coming. So it appears that other people didn't either, so I think I'm all right there. So I'm going to share some of the slides. I'm going to share my screen in a second, and I'm going to share some of the slides that Abraham shared with probably, I think over 500 financial advisors last week who use your software. I think you did that twice, didn't you? So that was probably 1,000 people that you shared it with. And of course, they shared this data. So
yes, yes.
And then Abraham's going to be available to ask some questions, but I'm going to just lead it through, share my screen, share some of the slides that he shared with me and everybody else. He'll discuss them a bit, and then we'll be available to kind of, if you've got further questions around this, then jump in a little bit later. There is a way to raise your hand. If you go up to the kind of, I'm in gallery view. I'm not sure you are, but on your screen, there's a little up to the top right. There's a little blue box that comes up with 3 dots, and you can click that. And mine just says chat, but maybe that's because I'm the host. You should be able to raise your hand. I'm not sure. Kathy, do you know, is that available on your
I can't see that, no. So we just have a square of 9 squares, and that view to gallery view. I'm trying to see how to do. No, so I think probably I can't see a way to raise your hands.
Okay, so all you have to do then, guys, is do this. All right, if you want to say something, you go like this. This is the old-fashioned raising your hand if you can't work. I'm afraid for the guys who've joined. Great to see you here, Jane Finity. But the guys haven't got video. I'm not going to see you raising your hand, but you can always put a message in chat. And Ryan is back at the office here, is hosting all this and making sure that he'll be trying to follow on what's going on. And if he sees anything on the chat, he'll jump in and let us know that we've got some questions. So right, I'm going to start off by sharing my. Great, Abraham said you can type in there into the Zoom chat group, which is brilliant. So I'm going to go and share my screen. And the host says I can't share my screen at the moment. Ryan, can you help me out? I might have to take control back from you if you're on mute, Ryan. I can't hear you.
Yeah, do you want to make yourself the host to be able to share your screen?
Okay. Right. So I'm going to just try and tidy up my screen a little bit. So can you all? I can just see you, Ryan, at the moment. Can you see my screen still?
Yes, I can.
Right. Great. So if you can mute everyone except for myself, Abraham, and yourself, that would be brilliant. So this is your first chart, Abraham, that I'd like you to discuss. This is what you sent across. And this is, from what I can see, is data going back to 1925. If you'd have put £1 in the UK stock market, if you could have had £1 back in 1925, it would have grown to £9,100 with annualized return of 12.39%. And we've got some colors in there. Can you tell me a bit more about this, Abraham?
Yeah, sure. So this is one of my favorite charts. This is called the capital market doesn't give a monkeys about your stupid politics chart. And essentially, it just shows, as you said, a pound invested at the beginning of January of 1926, and the growth of that, if you did that in the UK stock market, what we now know today as the FTSE All-Share Index, and it shows you the journey that that £1 would have gone through up until the end of December of 2019. And then, of course, you can see the red and the blue color that you see is essentially our political parties, right? The political parties in this country. And then, of course, you can see the name of each prime minister and the point that they came in. Essentially, and in the background on the chart, you can also see different events, right? So you can see, World War II there, the Great Depression, all of these events that the capital market or the stock market has gone through over that period of time. Essentially, the message here is that, the capital market, through good and bad times, is an incredible wealth creation engine. It doesn't care much about all the bickering that we do on politics and prime minister and things like that. The wealth creation engine goes on and on. And you know what? As an investor, you don't need to do a lot. All you have to do, all an investor putting £1 at the start of this period had to do is three things, actually. Invest, stay invested, and try not to be dead. Now, that's the way to think about it, I think.
Absolutely, Abraham. Absolutely. Yeah. And of course, I think in the midst of all these things, I'm just looking at this 73, 74 period down here when we saw a significant decline in the stock market. And if you'd have got out at this point or any point down here, you'd have missed this huge, huge bull run that really didn't finish, or the next market decline, I think, or the significant market decline was 87.
Indeed. So the advance of the capital market is permanent. The declines are temporary. The problem we have is that every time we have this temporary decline, which, by the way, it's part and parcel of the game. We have capital market data going back all the way to the 1700s. We have that data, not just for the UK, but for the US, for the global capital market. You see this same pattern everywhere, and so the problem is that every time we see this decline that is, temporary, people make, as humans, we make very, very, bad judgment, let's put it that way, that ends up doing more harm than good.
Yeah. So historically there, we've got, this is why we invest, isn't it? I mean, this is what we do. But to get that return, you've obviously got to, stay in your seat. I can see Mark has asked a question. Do you have the same with a linear scale on the y-axis?
Yes, so we do. So this is what is known as, Mark, I can tell you're a math geek, it sounds to me. So this is what is known as a log scale. Essentially, if I use the normal scale, so log scale essentially just go in tens. So we start from 1, and then it goes to £10, and then £100, and then 1,000 and 10,000. And the difference between each of those is not the same. It is the same. The difference between sort of 1 and 10 is exactly the same difference between 10 and 100. So it doesn't go in the linear way, i.e. of 1, 2, 3, 4, 5, 6. If we did that, essentially what you would see is this line not going up for much of the time and then shooting up in the end. That doesn't give us an accurate visual representation of the compounding of wealth that happens. So the benefit of using a log scale is that it gives you a clearer idea of how wealth compounds over time, a much better idea than if you use the linear scale.
Yeah, yeah. And I do have availability of that chart if you really want it, Mark. I can dig that out for you if necessary. So great. That's the first one I wanted to talk about. And then yes, so I'm going to come back to growth of wealth, Abraham, if that's okay. I think this is pretty interesting. The highest and lowest annual return, positive versus negative periods. So what you've done here, of course, is you've looked at all the different asset classes, all the places that people can save their money. And you're starting off with inflation because, of course, that's the real thing that we're trying to avoid is inflation eroding the value of our money. We know that if we leave it just in the bank, well, you move on from inflation to cash, and you can see that there isn't any negative periods there for cash. But yeah, talk everyone through this one.
So essentially, there's two sets of charts here. So you have the highest and lowest return, which is essentially just giving you a range of annual return from the lowest annual return to the highest one. So if you take inflation, for instance, the lowest inflation that we've seen in this country in the last 100 years or so is minus 8%. So essentially price actually falling, right? So in a year, what you paid, in that scenario, what you paid £100 for at the start of that year, you only needed £92 to buy it at the end of that year. So prices were actually falling. This is typically sort of during wars, during really bad periods. But on the extreme side of it, you have very, very aggressive inflation. So you paid £100 for something at the start of the year. At the end of that year, you are paying £123 for the same thing. And then, of course, you can see, the average. So which is inflation tends to do about 4% a year on average. Now, the lesson to take away from this, especially when it comes to investment into assets, is that the range of return is incredibly wide. We can't predict from year to year. I get this all the time where, people say to me in financial services, they say, Abraham, what's your expected return on UK equities, this year? And my response is, well, somewhere in the ballpark of minus 51% a year, and an incredible growth of £152 a year, somewhere in that tiny range. Why? Because I don't know. The experience over the last 100 years tells me it will fall somewhere in that region. Right now it's still very within that bound, that range. So I'm not worried. The second set of charts, so the pie chart that you see, is just the proportion of annual returns that are negative versus the ones that are positive. So if you think of cash, for instance, 100% of time you expect cash, to be positive, at least in nominal terms. Whereas equities, you would expect that, in 3 out of every 4 years, returns on UK equities is positive, and in 1 out of every 4 years, you would expect return to be negative.
And in essence, to get that, if looking at the UK equities there, we've going back to the data period of 2019-26, the average annualized return has been 12.4%. So to get that 12.4%, when you could alternatively stick it in cash and get a 4.9% return if you'd have invested that whole period of time, which is significant, you have to accept that prices can decline and prices can rise, and to get that higher expected return.
Yeah, this is what we call risk in financial services. Yeah.
Yeah. Well, though, of course, risk, of course, I always think it's an interesting statement. The risk is the investor behavior, because actually the investor who put his pound in 1926 and just sat on it for the whole period, or for most long periods, got a great return comparable to cash and comparable to inflation. So therefore, actually, is not the risk sat with cash?
Indeed.
Yeah. Have we got another question? Do you have charts that include the current crash? We're going to get to that, because I knew that you'd want to know that. And so therefore, yes, we've definitely prepared that earlier, which is great. So yeah, that's pretty interesting. You can see that for the portfolios that we're invested in, as clients of mine, you'll see that we're in the global equity portfolio, and there's a reason behind that. You can see that the downturn, that the 3 out of 4 year periods, the 74-75% against UK, these two figures are very similar between the UK global and the global UK, are very similar. But you see the downside of the world markets have been much less than the UK market on itself. So this is the benefit of diversification and why we're in a global portfolio. So just give you a bit of context around where we're currently invested. Okay, that's the overlay of all that. I'm going to come back to that in a second. Right, the bull and bear markets. Now, for those who aren't familiar with the terminology, the bull market is the market going up, and the bear market is the market going down. And can you give some context about what makes a bull market, Abraham, and what makes a bear market?
Yeah, sure, absolutely. So a bull market technically is a period where equity is grown by more than 20% from the initial bottom, from the previous bottom. And so we start to call it a bull market when it's grown by 20% from the lowest point of the decline, and then we track that, we enjoy that ride, we get excited and happy and all that, and then until we get to a point where it peaks. And then a bear market starts when it's declined by more than 20% from a previous peak.
Great. And then, of course, here, what you've actually got is that all the bull markets going again back to 1926 and the bear markets. Do you want to talk a little bit more about the history?
Yeah, sure. So essentially what this tells us is that, the bull and bear market cycle is part and parcel of investing. Bull market follow bear markets, and a lot of research has been done. Essentially suggests that the intensity, i.e. how deep and fast the bear market is, has some correlation with how high and long the subsequent bull market is. So you can see, let's take an example, the deepest bear market that we've seen in the last 100 years. It's essentially the market crash of 1973, 74, and equity declined by about 67%. And so, in other words, you woke up one day with a £100 in your portfolio. That's what it's grown to, from the previous bull market, and then over the and then the world obviously came to a grinding halt. Let's put it that way. And over the subsequent decline, over the following few months, you got to a point where your portfolio declined to like £33 from 100. And it took, the whole process took around 3 years, for that bottom to happen and for the recovery to happen. But if you stayed invested, you didn't panic, the amazing bull run that followed lasted 12 years and just incredible amount of return over that period of time. So as you were saying, again, let's cast our mind back to the last bear market, in 2008, UK equities declined by 41%. Your £100 at the top became, 60 at the bottom. That took just under 2 years. The whole pain lasted 2 years. But what did we see after that? A bear market that lasted, over a decade. So again, if I put global equities here or use US equities, we find the same pattern. Bull and bear, it's a cycle. The bull, delivers incredible return. The bear takes a little of it back. Bull market on average lasts about 7 years. Bear market on average lasts just under 2 years. So, and I think the next chart shows that a little bit more. Oh, not that one, the table. I had the table in mind, but never mind. You don't have it.
I don't have it. Hold on. This one?
Yeah, that one, yes. So this is just a summary. So you can see average bull market duration, 7 years. The cumulative return during a bull market is essentially 500%. Compare that to an average bear market that lasted about 20 months with a decline, average decline of 36% or 37%.
Yeah. And then I think, again, this kind of summary of the growth of £1,000 January 26 to December 19, and I appreciate we'll come on to the recent statistics in a second. But again, just look at the annualized return and the volatility, the annualized return of cash. So that it's saying that, you've got slightly more ahead of cash against inflation. I don't think that's true at the moment. I think inflation's probably running higher than cash returns, but this is the history, of course. The bond market at 7%. And then again, interestingly, what's gold done? It's always been, a store of value, but we can see that gold has had significant volatility, but actually hasn't provided the return comparable to equities, global equities, and emerging markets. And in fact, it's had a similar volatility comparable to gold. But
after the return, yeah.
But yeah, absolutely, against 8% against 12. So, and if you put that into the context of the numbers down there, what are the is this a growth of how much, Abraham?
Yes.
What nominal number went in?
Yeah, 1,000 at the top.
1,000, sorry.
Went in at the top.
Yeah. 1,000. So that's this is the reason we invest, isn't it? Right. Purely it's summarized in one chart, which is brilliant. Now let's get. I'm going to just have to flip to the big question. I'm just going to ask. Actually, has anyone got any questions that they want to ask before I go to the recent market performance? Unmute yourself if you want to shout out or type in the chat. If not, then I'll flip across. So bear with me. Okay.
Hello.
I'll let you take this one away, Abraham, and I'll just try and move the mouse and highlight the bits that you're talking about.
Well, we're still looking at your old bull and bear table. So
okay. Sorry, your screen is paused.
Justin, I think John might have a question.
Okay. Let's go. John, has he typed something in? Yeah.
No, he was just going to talk. I think he was on mute.
Great. Okay, John. Hi. Yes, John. How are you?
Okay, well, thanks. Yeah, my question is, the charts look great in terms of the growth, but they don't show it against inflation. And if you actually include inflation in, I wonder what the charts would then look like.
That is a brilliant point. So, Justin, if you move on to the growth of wealth that included all of the assets, that will give some context to this. Yeah. So no, that's a brilliant question, and we find. I mean, this may well just tells me, John, that you have a far better understanding than average individual around this, because one of the battles that we fight is trying to get people to understand real money, i.e., real money in real terms, net of inflation, versus nominal money, which is currency, right? And that's very hard. And when we made this chart, we decided, we had that conversation, should we put real money on this, or should we put nominal money? And we came up in the end with the fact that people don't tend to understand nominal real money, so we put nominal money there. But there is a really simple way to get real money, to convert everything that you're looking at here. So if you look at this chart, I accept this is quite detailed. So this is saying a growth of £1,000 over that period of time, of all of the assets and inflation. So you can see, what you paid 1,000 for at the start of that period, you would pay 34,000 for it. And the same goes, you invested 1,000 in global equities, you would end up with 10.7 million. If you wanted to get a sense of the real growth, in real money, all you needed to do is to divide the terminal value by, divide the terminal balance for the investment by the terminal balance for the inflation. So in this example, I just divide, 10.7 million by 34,000 to get the real inflation adjusted value at the end of that period. So that's a simple way to think about it. Of course, if you are working with Justin in our software, you'll be able to see the growth of wealth in real terms as well. So
yeah. Great. Thanks, Abraham. Does that answer your question, John?
It's just gone out.
Oh, okay. Right. I think I need to...
Can I just ask a quick one?
Yes, who's that? Sorry?
It's Nigel May.
Hi, Nigel.
Hi, Abraham. Looking at your graphs, would it be reasonable to say also another way of seeing the real return is the gap between whatever the line is and the inflation gap?
Yes.
Because effectively, even as you do that, over time, it gets wider. So I would say, from my background, that's what I would look for. Is that correct?
Indeed, yes, absolutely.
Absolutely. Okay, thanks.
Great question, Nigel. Thank you for that. Sorry, I haven't got my... I'm looking at all the charts and I'm not looking at all your videos, which is why I couldn't tell who was talking. Good stuff. I'll flip now. I'm going to just stop my share and then I'm going to share the right screen because that's where I went wrong last time. So I'm going to come back to you here, find the current chart and then... come back to Zoom, share screen, and there it is, share. So here we go. Over to you, Abraham.
All right. So essentially, what you're looking at is a different way of looking at just the bear market. So, the thing in the news right now is, this is the worst market decline of all time, since the Great Depression or this and that. The reality is that actually the current decline in the capital market, the current bear market, which started around about January, isn't actually that bad. I know it doesn't feel that way, especially if you're looking at your statements. So the lines that you're seeing here is the journey that £100,000 went through during each of the bear markets. So you can see the purple one. Justin, can you over your cursor on the purple charts? The longest one, the longest bear market that you've seen, and then the bottom. So put the cursor on the bottom at the deepest point, sorry. Before that, yeah. So the 1973-74 bear market essentially saw your £100,000 declined all the way to 33,000, bottomed out. So we sort of hit the bottom around about 30 months. So for over 2 years, you saw the value of your portfolio kept going down and down and down and down. And then ultimately bottomed out, and the recovery period started, and it took you in total 68 months to get back to where you started. And then the bull market started from that point, right? So we've had a lot of really bad market condition. If you look at the current one, it's not actually bad. So it costs on the red line there. So this is up till the end of till Friday. Essentially, the portfolio started declining. Your 100,000 is now, if you invested entirely in UK equity, is now 71,000. In terms of the depth of it, in terms of, where we don't know how long this will be, this is still very much within historical range. We don't see anything, to be overly worried about here. And I know I'm not underestimating the pain and the suffering and the incredible hard work that our NHS and the government and all these people are doing, just incredible. And I'm not underestimating the pain. But as far as the capital market is concerned, this is all normal. I'm sorry. It's totally within the range of historical outcome. I am not, as yet, worried about the current bear market. Call me when the decline gets to 63%, right? Call me when that 100,000 became, 33. Let's have a conversation then, But so we're tracking this, we're updating this table so we're charting the course of this bear market. So far, pretty normal.
Yeah, it's very much in the normal expected returns. To get that 12% annualized return that the markets have given before, you have to be able to sit tight when these market conditions present themselves.
And absolutely, and so this is one of the things I am very proud about. For anyone who's worked with you, Justin, and you've gone through Timeline and you've stress tested their plan, you've accounted for this kind of market conditions. It's all taken care of. We'll start to worry when something falls outside of the range that we've planned for. Yeah.
And I think what's relatively interesting as well is the steepness of the decline. And I think we all know that this decline will solve itself as fast as soon as we get a solution to the problem. And I think at that point the market will rebound very quickly. But of course,
absolutely. And sorry, just one point to make here. So Professor Goetzman at Yale University has done extensive work looking at the decline of capital market across 100 different markets, not the UK, over the last 300 years. Within that data set, you have some really, really bad pandemic. The Spanish flu, the outbreaks, pandemics during multiple periods. And the conclusion he came up with, from this research is that sharp declines tend to be followed by very sharp rises. So when equity, and by sharp decline, is really thinking about really bad scenarios. So when equity market across the world declined by more than 50%, the probability or the chances that they're going to recover, and that recovery is going to be very sharp, is incredibly high. And so sharp declines tend to follow sharp sharp rises tend to follow sharp decline. This has been studied to the nth degree. Again, as I said, I am not underplaying the crisis that we're in. I do have faith, though, in our ability as a race, as a human race, to overcome this. And one of the incredible thing with this is that we're not fighting each other, right? This is not, World War I, where we're trying to kill each other. All governments, all peoples of the world are fighting and working incredibly hard to overcome this single enemy. I have absolute faith that we will.
Yeah, fantastic, Abraham. And I put the link to that study in the chat as well, if anyone wants to read more data and more information on the study that Abraham just referenced there. So, right, well, I appreciate that, Abraham. That's been fantastic. That whistle-stop tour there of stock market investing. I know a lot of you will have heard me witter on about all that in the past, but it is the time now where we've actually got to sit on our seats and stare out of the window and actually turn off the news a little bit. I often think that unless we actually can make action with the information that we're getting, then actually it's not serving us at all. In fact, most of it is just causing anxiety, and we should focus on the things we can control, and sadly not do much about the things we can't. So can I open out to any questions, any kind of considerations? How are you all? I mean, what's been happening? What's been happening the week? Have you all got toilet rolls? Have you all got, have you all got the things you need? How is everything? Has anyone got any crises or problems that we can help with? How's your week's been? Oh, Nigel's saying something, I think, but he's on mute. Is it up to me to unmute everyone?
No, so thanks for asking, and that was very helpful, Justin and Abraham. I think it was a wise person, you, that actually said it was time in the market as opposed to timing of the market. And I think everything that you've said today simply reflects that, doesn't it?
Yeah, it does.
Very helpful. So thank you very much indeed.
Good. Well, I'm glad it's been useful.
Alan has raised his hand, Justin.
Alan, where are you? Can't see you. There you are. Can you unmute yourself, Alan? Or
he has, yeah.
Great.
Yeah. My question is to Abraham. Primarily, do you also think, having reflected on the positivity of all governments and all countries suffering the same problem, do you think there's a possibility that they will also work together economically to improve the situation that we are currently in?
So, to an extent, I know each government is still trying to figure their way around this. I'm not an expert in government policy or whatever, but so far, the UK government is pumped or, announced £300 billion worth of economic package. Now, since then, they've added more, the self-employed support, cancellation of NHS trust debts yesterday. Essentially, they've put back around, that plan is putting back around 20% of our annual GDP in money back into the economy. It's just insane. In the US, those lots are crazy, right? They've announced $6 trillion of money back into the economy. I think $2 trillion of that money is going to real people, the other into businesses and corporations and things like that. Just incredible. And now the EU's done something. I haven't followed that massively. It's just incredible. The thing, though, is that as far as the capital market is concerned, the US account for 50%, 54% actually, before the decline of the wealth on the stock market around the world. Us in the UK account for 7%. So between those two, that's enough money going in to shore up what is essentially 60% of the capital market. China is already coming out of it. Now, as I said, I haven't seen anything to say that they are all working together and coordinating sort of, orchestra like they ultimately did during the global financial crisis. But each region or each country right now is taking steps, to address this problem from an economic standpoint. I hope they will. I think they will. But right now, everyone's trying to fight the fire in the backyard. Once we deal with that, I hope that we will see more coordination, around between governments around the world.
Can I just develop that slightly, Abraham, and say, can you give us a perspective to what extent we might be mortgaging the future? So by that I mean, to what extent my children and my grandchildren actually be paying for the massive investment being made over the last 3 months. That's just an enduring concern for me. Makes sense?
Yeah, I mean, I think there's a lot of points in that. One of the good things about the current situation that we're in is low inflation and low interest rates, right? So interest rate is basically zero. We're borrowing money now with no interest. Now, I'm slightly equally worried about that, mostly from the point of perspective of inflation. What happens when you pump this amount of money into the economy? What happens on the other side in terms of the cost of living? But I think you have a really great point, which is, well, what about the debt? Well, I think that it will be unfair to say that our children are going to obviously end up paying this money. We're going to pay some of it, but we're making these decisions for our children as well, because there are families that need to survive. There are hospitals. Children need to be treated. So we're making these decisions for them. I think we should prepare ourselves for tax rises. When this is all over, we're all going to pay more taxes. Heaven helps me. I would pay more. I just hope that our politicians would have the balls when this is all over to start raising taxes, obviously not in a way that destroys the economy, but in a way that we can start to pay some of that money. The good thing, though, is that we're borrowing money. The government's going to be borrowing money at zero interest rates, which is often fixed, for the next 30 years or so. And actually, if inflation rises, cost of living rises, we are effectively chipping away at the value of this debt. I'm not all that pessimistic, I don't think.
I think the other thing, Abraham, of course, as you rightly say, that inflation quite easily could rise with the amount of money which is pumped in. But
yes,
the only hedge that we've ever really had against inflation is real assets, so equities.
Absolutely. So I think the government would try maybe not even deliberately, to inflate this debt away. Again, which is to an extent some danger investing in bonds right now. Bonds actually done really well. They've held up a lot. If you have bonds in your portfolio and you need to tap your portfolio, it's okay to tap the bonds because it's made barely any losses. But going forward, the government's probably going to try to inflate away its debt. Bonds not going to keep up. Equities, obviously, is what tend to keep up in those sort of high inflationary environments. I don't know. We've gone all over the place. I don't know if we've actually answered John's questions or Richard's question.
Nigel.
Thank you. Very balanced answer. It's the balance between the short term today and the medium and longer term, isn't it? And it's a balance on a daily basis.
Yeah.
Yeah. So anyone else got any comments? Anything that's going on in their worlds that they'd like to chat about? John, how is everything? Are you still managing to stay in lockdown there? How on the farm?
That's you.
Talking to me?
I am, John. I was just saying.
Well, not enjoying it, but I think you feel privileged to have a bit of land out there, a good space around us.
Absolutely, yeah. Well, it's a lovely spot. You're in a lovely spot to be to not be able to go out. So I think we probably all are, actually, aren't we? We're all very privileged to live in this part of the world.
I have one sort of silly question, if you don't mind, really, but I don't know anybody would know the answer. I really can't understand economics, never have been able to. I mean, why don't we just print more pound notes? So that's what I don't understand. Does anybody have a sensible answer to that one?
Abraham.
Well, we are
absolutely. by borrowing this level of money, we are.
But also some of this money is essentially the central bank. Someone at the central bank basically just, making up money. They type in 300 billion pounds into the economy. We are printing money.
Yeah.
Right. Okay. If I could win some money, that would be good, I guess.
That would be illegal, but okay.
Okay. Thank you.
Marissa, how are things? How are things? For you, for Lester Aldridge, working from home all of a sudden, and you're in the wills and estates and trust planning and powers of attorney and all that type of thing. I can imagine that lots of people are trying to talk to you at the moment.
Yeah, it's a really interesting time, actually, because the things that we're trying to remind clients to do anyway, now realising why we are badgering them all the time to make sure everything's up to date, because at times like this, when things are so uncertain, it's when you want to know that you've got everything in place, your will in place and up to date, powers of attorney in place, should you not be able to make decisions for yourself, whether it be financially or for your health and welfare. But also, as I mentioned when we spoke yesterday, Justin, it's a really good opportunity for people who do want to undertake some inheritance tax planning, because whilst the stock market is down, if you've got that nature of assets, it's a really good time to get them out your estate at a lower value, and for your intended beneficiaries to benefit from the stock market increasing when that does eventually happen. So there's a lot for us to think about at the moment, and it's certainly keeping us busy.
I'm sure. So anyone else got anything to say? Anyone, as we come kind of towards the close, anyone got any further last questions? We're not holding a Retirement Cafe event next Friday because I'm running a training event that we were supposed to be doing at Gaunt's house in Dorset, but we're now doing on Zoom to about 8 to 10 financial advisors for 4 days. So I'm out of the game as I'm teaching on that. But following Friday after, is our next event. The podcast is continuing to go out and getting lots of downloads. And again, I thank Abraham for his sponsorship of that. This week's was Rory Sullivan, I think, from Ogilvy, he was on for about an hour. I think he pretty much talked at me. I don't know if anyone's listened to that, but it's an entertaining podcast. So if you're in lockdown and you get bored, why don't have a listen to that? Please leave a review if you're enjoying that as well. And we've got lots of more interesting guests coming on soon. So thank you for all your time and for your attention today. It's really does appreciate it. It's nice to see all these faces. It would be nothing worse than to put on these events and just find Kathy and Ryan and Leslie attending. So please, anyone can join. Let all your friends know. It's a good place to hopefully come and get information and things that might be concerning you. So if you have any kind of questions you want to send in or guests that you'd like me to get on, I'm always trying to think about bringing someone on that we can all benefit from. But if you have someone you think that, I'd love to know more about that, then let me know, or Kathy know, or Ryan or Leslie, and we'll try and endeavour to help. So thank you all for attending this morning.
Thank you, Justin, and thank you, Abraham.
Thank you.
I should probably unmute you all if I can. I don't know if I can do all that, but you can all.
Thank you. Thanks.
Thanks so much. Cheer, bye.
Much, yeah. Right.
Thank you.
Thank you. Bye.
Bye. Nice to see you all.